We present a matrix detailing some movement in some key market rates, domestic and global, and key events. As we pen our monthly newsletter, the Monetary Policy Committee of the RBI kept the repo rate unchanged at 6.50%, a first pause after a series of rate hikes. The MPC also decided to remain focused on withdrawal of accommodation to ensure that inflation progressively aligned with the target, while supporting growth. Interestingly, it was a unanimous decision for a rate pause and a 5-1 decision on the continued withdrawal of accommodation stance. The CPI inflation was projected at 5.2% for 2023-24, with Q1 at 5.1%, Q2 at 5.4%, Q3 at 5.4% and Q4 at 5.2%, and risks evenly balanced. The MPC, however, continued to warn, there can be no room for letting down the guard on price stability. The Argus eye on inflation continued. The debt markets reacted favorably, and the benchmark 10-year gilt has moved down to around 7.20%. As we look through the past month of March, the benchmark 10-year gilt rates had moved down by around 10 to 15 bps through the month, with a softening bias across the curve. The inflation date printed on the higher side and the core inflation remained firmly entrenched above 6%, meriting a continued vigil by policymakers. In the US markets, with problems emerging in some banks, witnessed a risk-off trade with 10 years moving down by around 50 bps to around 3.47%. Gold also followed the risk-off trade, touching almost an all-time high. Looking ahead, we think the domestic rate cycle is close to its peak. While RBI, after today's pause, will continue to maintain vigil over inflation, may have a bit more rate, the markets have largely priced in such rate hikes, should there be any. With RBI projecting an inflation of 5% in the second quarter of fiscal 2024, the time is now apt for looking into fixed income products across all duration segments, with commodity prices, crude and agri-commodities softening through the past few months. We think a sustained commodity slowdown may provide a respite to the retail inflation. The bear flattening of the yield curve, especially in the 1 to 5 year segment, has largely happened, hinting at the possible end of the upward movement of the domestic rate trajectory. We also believe that AA credit spreads are very tight, and the probability of spreads to increase soon remains a distinct possibility. Liquidity being gradually normalized, the extreme short end of the yield curve will also remain under pressure. With US Fed trying to engineer a soft landing to the economy, there has been historically no precedence of inflation remaining high after recession, which possibly also bodes well for fixed income allocation. What should an investor do? While there have been tax changes announced in the debt segment, we still believe, beyond the tax changes, the merit for debt mutual fund investments continue. We believe that the investors with a shorter time horizon of less than 1 year should continue investments in ultra-short-term and low-duration funds. Short-term fund category may be suitable for investors looking to stay for a time horizon beyond 1 year with a lower risk volatility. For investors who attempt to capture the interest rate cycles, an allocation to dynamic bond fund merits attention. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.